just to tell you guys a little bit about myself, I always like to start out this way. I am not and did not come from a traditional investment banking background. I did an internship when I was in college um, at an investment bank. I played golf at University of Kentucky back in the day. And outside of that, though, I went immediately into the insurance world. I worked for a major insurance marketing organization for about 9 years, and then ultimately moved into the investment world at the greatest time, 2008 in August. I decided that it was a right time for me to move from Sarasota, Florida to Los Angeles and get into the investment world. So about the middle of 2009, I took a job with Merrill Lynch, worked there for several years at the private bank, and then after a few years, worked for a couple of family offices and realized while I was working at these family offices, I was really doing sell side investment banking. And my sell side investment banking and doing the due diligence for these families on the private vehicles that they were purchasing. I was acting as an investment banker. I was doing the due diligence. I was valuing these companies and really understanding the architecture and the finances behind them, but I wasn't getting paid like one. So a couple of years ago, I went to a boutique investment advisory firm out of New York called Bankers Capital International, and that's where I sit today. We're a smaller boutique firm who really specializes on that lower middle market corridor. We're mainly sell side and M&A folks. So we're not doing a lot of those capital raises where we're taking companies public. We actually hand those off to other firms that can handle that a lot better, that normally have wealth advisors or managers that can work with that and take those companies public. So a lot of Series A, a lot of Series B. The main kind of attraction is normally $1 million in revenue up. Normal capital raise is somewhere north of 15 million. So that's kind of the gist of where I am now and who I am. When I say boutique investment firm or investment bank, I really want to explain what that means to everyone. It's to me, and coming from the wealth management side and the insurance side, you have these wonderful founders who find companies and they have this great idea and they start growing it. And they get to a point where they realize that they don't have a rich uncle that can finance them and get them to that next level. So that's where I come in. I work with these folks. I help them narrate their story. I work strategically with them to find value-added partners, to not just find money for them that they can sell off their equity in the company and or raise as debt. I really try to align that with someone strategic, someone that's going to add value to that company. If it's a software company, does the person coming in utilize software in that vertical, or does it match up or pair up with the customer base that they have so they can accelerate the growth of that company as well? So there's actually more to it than just finding money from the side or the seat that we sit in here. It's about finding the right capital for those partners to make sure that not only are they getting funded, they're actually in a better place because they have a partner that can help them accelerate sales right off the bat. So when I talk about boutique, that's really it. And I do sit down in Sarasota, Florida again. I moved back here several years ago, and I just deal with the heat in the summertime. That's about it. But I no longer have to go to the city on a regular basis, so that's a wonderful thing. So let me hop into it real quickly. I would say this is probably going to last 35, 45 minutes. And what we'll do is, I know I've seen some folks in the chat room already. At the end, Scott will read off those questions to me, and then I'll go and answer them at the end of the presentation. So when we talk about functions of an investment banker, there's really kind of three distinct silos. You have equity and debt analysis, you have buy side, and you have sell side. So equity and debt analysis, pretty straightforward. I mean, you're just analyzing equity of a company, whether it be public or private, and debt of that company. More on the research side, I would call it. Buy side engagements are really when a customer kind of comes to you and says, "Hey, let's look out into the ether see if there's an opportunity for you to find somebody that wants to buy my company. I don't do a lot of buy side stuff, so you'll see most of this presentation is going to talk about sell side. So it's going to talk about advisory service and market making and really raising capital for companies. That lower middle market again, we're talking companies with valuations probably under 350, 400 million is really where I play. Because once we get up too big, then I'm competing with a lot of the bigger investment banks or larger banks that are really, they're just better suited for customers like that. And a lot of times when I get a company to that stage, at that point, I'll partner with the Jeffries, or I'll partner with the Citi, or I'll partner with the Goldman Sachs and bring that client to them because they're going to be able to raise a better type of capital for them and take them public. Oh, okay. So, let me make sure that didn't go. Okay. So sorry. So we'll start with equity and debt analysis. So equity analysis, evaluating company stocks, determine their value and potential growth. So you're analyzing statements, you're looking at the tea leaves, trying to figure out the economic conditions that are out in the environment. You're forecasting and giving research out to the wealth advisors so they can go sell their clients and or institutions, hedge funds, so on and so forth. Debt is exactly the same thing. It's just analyzing all of those financial things, but usually here you're also throwing in government or municipalities where there's a lot of research there. I ask people all the time, normally in an audience like this, does somebody know the difference in the size of the debt market, uh, globally compared to the equity market? And the debt market's about 4 times larger than the equity market. So there's a lot more debt in our system. Our system is built on debt, and it's built on financing structures, whether they be highways or bridges or just corporations in general issuing bonds. So the debt market is pretty broad, it's pretty vast, and covers so many very neat subjects. But it's a little bit slower, and the beauty of it is it's really, again, going back to it, it's how this world works is on debt. Um, Here we have a little slide on, not only the sell side, but also the buy side, breaking down the differences between the two. When you're on the sell side, you're really doing the underwriting. And again, public, private companies, they both need to be underwritten. When you're working on a Series A round and you're raising $15 million for a company, we're valuing that company. We're looking at that stock, trying to figure out what the best way is to issue that equity and or go out and pull that debt down for that company. I mean, we love to work on the debt side if possible, but when you're talking about lower middle market companies, as most of you probably know, being CFOs or CPAs, cash flow is king when it comes to getting debt. And if these companies don't have positive cash flow and consistent cash flow, they're really going to have to give up equity, which is rather expensive when you go out to the market and compare it to what you can get a debt placed for a 10 or 15-year period. So it's really nice to be able to issue debt first or grab debt first, as opposed to go out and sell off equity in the company. A lot of what I do falls under this advisory services, whether it be M&A, whether it be just valuations of company or modeling them out for them, or working with that CFO to really build out the model. That's the main function of my job, is to really sit down with them and work on those financials so that I can go back and make sure that the business model, the deck that they put together, whether it be an investment deck or a marketing deck, it pairs up with those predictions and that analysis. Far too often, what I find is you have these wonderful projections, but then when you go back to the actual investor deck that's issued, it doesn't match up, and it doesn't talk about how that business could actually grow and scale at the pace that valuation model is actually being built out. So um, we spend a lot of time there, market making as well. That to me, that's one of the fun parts of the job is on the private side, non-public, is to really go find whether it be institutional capital from a hedge fund or high net worth individual or family office, private equity, even venture capital from time to time, to talk through the deal, to really get them interested, to answer the questions about the company, and to realize that I have narrated that story to match up, and it's resonating with the audience, and that we don't have to do too many tweaks. So that's when I really see it and know that I did a good job on that narration, and everybody's telling the same story, from the CEO to the CFO to the employees at the company that we're working with. Everybody's telling the same story about where the company is today and where it's expected to grow to. Um, don't do a lot on the sales and trading side, but that's more of your large investment bank. You're talking the Goldmans of the world, the Cities. They're doing a lot of the sales and trading side, more on the research as well. Uh, they have the analysts that are constantly doing this research, feeding it over to the sell side advisors, so the sell side advisors can put together kind of dossiers on these different groups or different companies, so that dossier can then be used to help in the reading. Syndication, just another fun tool of finding, for example, in a debt structure, maybe multiple banks to come together because one bank couldn't do $100 million loan. However, five banks could come in, and one would lead with maybe 25 million, and the other banks would take up the other portions of that trade. So a lot of fun to structure those deals. We're seeing a lot of those deals on the development side down in Florida, uh, with respect to either condos, redevelopment due to the hurricanes that have come through here the last couple of years, whether it be Sarasota or St. Petersburg. Also, assisted living facilities are a very big commodity down here that we see a lot of syndicated loans going in to put those together as well. But then when you flip to the buy side, um, which is something I really don't do, because the deals are very difficult, and you're really searching for folks who want to come in and take over, either it be a company and or you're on that side of trying to unload stock, and companies that have distributions are far better suited than a lot of boutique investment banks. You want a group that has a wealth management side or an RIA to where they can go out and really get rid of those things. That's why you're seeing asset management, investment management, research and analysis, portfolio management, due diligence. I don't know why that's just here, but that's universal. I mean, we all do a deep dive in due diligence, and that's something that I'll go through here shortly. Due diligence is really the lifeblood of this business. It's understanding your clients, understanding the information that they gave you, dissecting it, asking questions over and over again to make sure that everything you have and say is fully accurate, because we're all fully licensed through FINRA, so there's a lot of T's you got to cross, there's a lot of I's you have to dot, and you just want to make sure that you're constantly doing that due diligence and checking and making sure and double checking, to make sure the information not only that's provided to you, but also that you're regurgitating and putting back in documents is accurate and actually works out. And again, going back to it, matches up with the decks that you're putting together, so that everything is there and it's cohesive. Uh, so I spoke earlier, and I don't want to blow through this presentation too quickly, but we're really a boutique advisory model. So there's really two areas of expertise. We're talking mergers and acquisitions. You're talking capital raises and restructuring. Um, a lot of these companies come to us. They need some recapitalization. They need restructuring. They need dollars. That's really the genesis. If I went through all of the companies I'm currently working with, I have AI companies, I have electric vehicle platforms, I have uh, a company that's doing different types of alternatives to styrofoam that I'm also working with, to a biodegradable styrofoam to raise money for them. So all of these groups are unique in their own way, and the beauty of my job is the autonomy of I get to take on whatever type of company that I want to, and I understand, but more importantly, that the family offices that I mainly deal with have an appetite for investing in. So the vast majority of times I'll do a lot of due diligence on the front end with groups, especially when I'm doing capital raises, um, and really interview those companies to figure out, like, what is their why. I mean, simple things like that all the way through. Where are they trapped? Did they not build their foundation big enough? Did they not start with an exit plan in mind? Is there was the thought the next generation was going to take it over, and now it's at a point where the next generation doesn't want it, and we're trying to replace an owner with somebody that wants to come in and run the company. Why are we recapping? Why are we raising money? How are we going to raise money? Is it debt or equity? But I love to just talk through this with the clients, really understand where they are in the process, what their mission is, how far along they are, and how do we get them to that next step? How do we get them on that next platform, so that they can go to the following one and the one after that. And so that's what makes the model very, very fun, very interesting, and really aligning folks. When you're working with clients, and you're raising capital for them, I tell clients all the time when I'm sitting in meetings that this is an arranged marriage. This is very difficult, because when you bring in a capital partner, for example, if you bring in a venture capital firm and they want board seats, I mean, they want to be involved. They want to push you. They want to make sure you're hitting the goal because they want their investors to get returns. So we have to take that into account. If you're a CEO that's not going to do well with the VC, maybe we go to more institutional capital where it's more passive, like a hedge fund or a high net worth family that adds strategic value. They own companies that are inside of your vertical. There's a lot of ways that we can go about doing it. It's just a matter of spending enough time with the client so that we truly understand who that client is and how we're going to hit the objectives with them, or do we need to move that founder to the side and bring in a professional management team, a CEO, a CFO, a CMO, which a lot of times is the next step for us. But we get to start early with companies, so most of them don't have too many problems at this point. However, we get to figure out those problems and those issues, build their foundation bigger, create a better architecture for them so they can grow and advance and get to that point of exit and or going public, or however they want to go about running their business for the remainder of their position there. So this slide I'll spend probably the next 15 minutes on. It's the slide where folks ask the most questions normally. And this is the process that we go through as bankers in our model. So it really starts, and again, the lifeblood of our business is due diligence. So it starts with a due diligence, a small due diligence package to really understand the company, financials, business plan, business structure, types of debt or equity they've already sold or raised on. Also, the current cap table and the executive team and the management team. We want to get a good understanding that there are folks there that have produced in the past, that have had either exits and or have a history of really being accomplished in the roles that they play. I kind of adhere to the Ben Graham and Warren Buffett theory of I like to bet on that on the correct jockey and horse. I mean, that's who I'm really going after is that management team. I want to know that they have a history of being successful. The more often when I find a team that's been successful, because when we get through this process and we create that investment deck and finally go to market, I would say 8 out of 10 times the folks that invest are investing in the people and not the widget that's being produced by those people. They're looking at the people and saying, can they actually build this company to where it needs to be? And that's where I find capital most often is in those folks that say, oh, this management team, it's like bringing a bazooka to a knife fight. They're unbelievable. I love where they're at. And I know they can get this there because they've been accomplished everywhere they've been along the road. So a lot of that due diligence is done very early before we ever get to the point where we sign an LOA or actually say that we're going to take that client on. That step doesn't happen until the terms of engagement about 4 steps from there. After the due diligence period, we go into a data collection, financials, business plans, cap tables, list of liabilities, like all of the things that most of you probably put together on a day-to-day. Those are the things we're going to look at. We want to understand where that company is and how it matches up to the business model and how those business leaders are going to run, how those executives are going to run that company. That's really where we're looking at. And then the analysis, we probably spend a week to 10 days on this prior to ever coming back to you and having more calls with management and having more calls with the CFO and CMOs and the key employees that are at that firm. Because a lot of times the best information comes from the manager that's on the floor or the person that runs the office. They're giving us the best information and they're really telling us and identifying where this company is and where we think the growth potential of it is once we do take this to the investors. The terms of the engagement after we've elected and really understood, we want to work with the company. We see a company and we say, hey, this is the company. That's when we get to the retainer. We always charge a retainer. And we always have an exclusive on the deal. I've had a lot of people tell me, no, they're not paying me a retainer, and no, they're not going to give us an exclusive. And I frankly walk away from those deals. I find that when I charge a retainer, the client gets me the information a lot faster that I need. The engagement's a lot shorter. They're a lot more proactive. And we usually get to a point where we've just created all of the documents that we need to create a lot faster because they're uploaded quicker. They work a lot harder, and the retainers aren't absurd. They're not 150,000 or 100 grand. I mean, my retainers are normally somewhere from 15,000 to 50,000 depending on the company. And it's really just that's the buy-in of that CEO or that company and the board. We charge a fee for the equity raise, of course. We charge a fee for the debt that we raise. Those fees range. Equity is usually somewhere between 4 and 8%, depending on the size of the company and the difficulty of that raise. Debt is somewhere between 1 and 4%, is what we're charging. And we do we have charged advisory fees for companies that just want to engage us to bring us in to test the market for them, to really figure out and put all these program or put all these decks and really do the due diligence for them to tell them where they're at in the market, how close are they, how far away are they, can they raise money. The other thing that we'll raise or we'll charge an advisory fee on is for a merger and acquisition. For anybody that works in that space, it's becoming a lot more common, especially in Florida. A lot of folks retire early, come down here, start a business, and the next thing they know, they have a HVAC company or they have a retail shop, and it's worth 15, $20 million, and they don't have anybody to come in and take it over, and they didn't do an ESOP or anything of that magnitude. So it's either a private equity group that's coming in or VC fund that's coming in that's buying majority positions in a lot of these HVAC or plumbing, electrical. A lot of the service businesses seem to be being bought up like this, but also you see a lot of M&A in the advisory world for investment advisors. The large firms being brought in to buy them out or to take over some equity in their position, and they get to take chips off the table, but they still work there. Those groups come to us because they don't know what the actual value of their company is, and they're negotiating with folks who it's their job to figure out how they can whittle down their their willingness to pay you to the lowest dollar. And they have just groups of associates and VPs and managing directors that are sitting there combing through all of your financials, trying to figure out what's wrong on page 17 of your business plan, and how it doesn't match up with your balance sheet, and how your income statement's off. So a lot of folks don't know how to do those valuations, and there's a lot of folks that are selling businesses that are very meaningful. They were maybe lifestyle businesses at one point, but now they're at a valuation level where they really need a professional, whether it be myself or one of you, to come in and help them. So it's a very big market, and there's a lot of transition as the baby boomers are moving into retirement full time. They are selling off those businesses. Um, After we do actually have an LOA signed and we go through that process of redlining and sending it back and forth several times, at that point we'll take a deeper dive into the data collection. We'll work off a due diligence checklist. There's probably 30, 40, 50 items on there. If a company doesn't have a data room, we'll create one for them. We'll start dumping all of their documents in there to organize them, put them all in one place under specific file names and headers so that we know exactly where everything is. During that deep dive, we're looking for everything. So any litigation that's been in place against that company or for that company, we'll take that all in. IP patents, any filings that they have, large shareholder or debt holders. I mean, I don't know how many times I've gotten in a company and thought it was in a great spot, only to find out that one of their major shareholders came in and bailed them out with $20-30 million worth of debt at some point. That's convertible at maybe the round that I'm on or a round after that. So all of these things get vetted at this point, and we go through them with the fine-tooth comb. This is the same spot where as we transition over into the creation of marketing materials, this information is vital for us to get as much as humanly possible so that we can expand on that and really build that pre-NDA deck so that we're ready for the market. We can build a pre-NDA teaser. We can put together a post-NDA deck, and really post-NDA deck is just with the financials, the financial models, all of the things that are unique to that company, maybe a little bit of the IP that's not 100% protected. Maybe the patents have been filed, or they just have a secret way of marketing that's a little unique that we can't hold. An NDA just needs to be in place. But we do build the financial models here as well. We do it in tandem with the company and with that chief financial officer, our goal is to make sure that they're giving us the best possible numbers and that we're replicating the type of growth that's going to come out. Because we know the companies that we work with in this lower middle market, the growth isn't linear. I mean, it's not just straight up and it's not 15% a year. And I hate it when I see financial models that do that because I just don't believe it's realistic. If a company's really going to go, it does have a J curve and it is somewhat parabolic in growth. So how do you model that out accurately without making that upward slope too steep to where it really scares off people in disbelief? So there's a lot of due diligence that goes into looking at other companies that maybe are similar or in the same sector. How did they grow? How did they expand? How do we go back in the modeling and make sure that we're not misrepresenting and kind of overstepping and overdoing what we say we are? And then as we go to market, I mean, this is the fun part, right? As far as I'm concerned, when we go to market, that means we have all our ducks in a row. We're ready to go. We're going out there and we're hitting the private equity, we're hitting the VC, we're hitting the hedge funds, we're hitting the other institutions, whether they be pension plans or whoever. And then we're also hitting those family offices and ultra high net worth folks. This is the fun part because this is when we really get to talk to tell the story for the first time to a third party and see how it resonates with them. See if they're understanding how we're trying to deliver a very solid business to them at a good multiple where they can make a significant amount of money when this company performs the way that we've predicted. That's the fun part is getting them on board to see the same vision that not only we see, but also the owners see in the company and the executives. And we learn a lot about us here. We learn a lot about the company here. We learn a lot about what the investors on the other end are really trying to get out of that company by the questions that they're asking. And every time we go through this process, I have to be honest, I pick up things that I would have never known before would mean or be valued by a company or I'm sorry, by an investor. And it's a question that I usually add all the way back at the start of the due diligence process because I want to make sure I have the answer to that. So if I get asked it again, I know the answer when I'm on the phone with those folks the first time. And then finally, the raise, the sell, the acquisition. I mean, once you do find that family office, once you do find that team that wants to purchase and they want to invest, how is the deal structured? How are all the parties at the table? Does everybody have a good bedside manner? Do they align in ethos? All of these things are things that I really try to flesh out here, so that when we get to a point of finding consummating this deal and moving it over to these groups working together, that arranged marriage is actually a solid one, and they get along and they really inspire and thrive together, so that I'm not putting them in a situation where they're struggling and they're upset and they're both coming back to me telling me that wasn't the right group and this isn't the company you said it was. I mean, the goal is to make sure that all of these folks know what's going on in this company. All the ducks are aligned. All of the internal information is transparent and easily readable by the investor, and the owners in the C-suite or the executives are being transparent and really embracing the opportunity to work with the folks that are coming in. So that's the matchmaking that takes place at that final step, and a lot of the negotiation is understanding how these folks are going to work together. It's not all quantitative. There's a lot of qualitative aspects that take part at the end there. With that, I have I think one more slide. Yeah, here we go. So I love to kind of end with this because a lot of times people ask me why companies don't accomplish their goals, why they don't get funding. And it's not all because the company's not good or the company's not sellable or there's there's a problem. A lot of times what it is they chose the wrong investment banker or advisor. A lot of times they choose an advisor that's more institutional and they need family office capital or they need high net worth people to invest. Or in the other end of the spectrum, it's a biopharmaceutical or a biotech company, and they hire an advisor that doesn't have access to VC or family offices that invest in that aspect. Not financial services is not a generic term, as I wrote here. Far too often you hear financial services, and what does that mean? Is it a CPA? Is it a wealth management? Is it a single family office? Is it a multi-family office? Is it an investment banker? Financial services is very generic, and far too often what I find is when I talk to a client that's trying to raise money and it's the first conversation and they say, I'm not paying a retainer and I'm not doing an exclusive, that's usually telling me right off the bat that somebody took a retainer from them in the past, they didn't perform, and that's why they're not doing a retainer and they're not doing an exclusive. And that just means, that they didn't pick the right advisor. They didn't ask the right questions. They didn't do due diligence on that banker before they brought them into their team. And that's the first thing when somebody's hiring me. I tell them, hey, here's my LinkedIn. Here's who I am. Here's our firm. Here's a pitch deck on our firm. Do your due diligence. Make sure we're the right firm for you, because I want to make sure I'm the right fit for them and I want to make sure they're the right fit for me. If I can't raise capital for those groups because I don't have access to, say, a biopharmaceutical group that's willing to do a product that has a total addressable market that might be a little small, I tell them no. I usually say, there's several banks out there that specialize in this. You should probably scour the globe and try to find one that it really makes sense to go to and have them help you, because I'm not your guy. So that's kind of the first thing that I see. The other thing, the next thing is poor financials. This will hold a company back from raising capital. They have no CFO, they have no CPA, they're using a bookkeeper. A lot of times they're putting on an Excel spreadsheet. And a lot of these companies that I come to, they've got 3 million in revenue or 3 million in sales, let's call it, on an annual basis. They're post revenue, so they're making money, but they haven't taken the time to hire a CFO and made their books professional. So that company, it's very difficult to raise for. It's very difficult to get an investor excited about them because the reporting is usually bad. The bookkeeper has it set up wrong. Their QuickBooks looks awful, and we spend a lot of time there. And there's just, I get so many deals a month that come to me. When I see a company like this, I know until they take the money and they go hire a professional to do this for them, they're really going to struggle to get to the next level, because there's just they're building their house on a dirt floor. They didn't take the time to concrete in a foundation, and that's normally the style that I tell them. The third thing is the business itself is a lifestyle business for the owner. Once they hit a certain salary that they want to make, they're not really looking to expand the company. They're not really looking to accelerate the company. And that's just not what investors are looking for. They're not looking to make it so you're comfortable. They're looking to it so they get a return that's outsized of what they can get in the capital markets. They're giving up liquidity and they're betting on you by investing in their business. So when I see businesses like this that I know the CEO has, or the founder has no real desire to build it any bigger than just the amount that they need to live their life comfortably. That's the other business that it's just not going to get funded, because that's not what investors are looking for. The final one, this is the one that always makes me chuckle. Delusional valuations. for those of you that have worked with entrepreneurs in the past or founders, far too often, the entrepreneurs or the founders they're delusional. They believe their business is worth $1 billion and it's already a unicorn, and you can't move them off that number. And they're trying to raise 5 million for a Series A, and you're looking at them and you're like, your pre-money valuation is not 95 million, it's 20 million. So for that, let's call it 5 million, you're give up 20% of your company. Oh no, I'm not willing to do that. I'm only willing to give up 3% of my company. Well, company's not worth that. The folks that come in, they're going to want to write their own terms. They're going to want to have a valuation that works. It works in both sides' favors, but it's not delusional. And far too often, I do see valuations that come across my desk that just frankly, the minute that I get the deck and I start reading through it, there's nothing I can do with it because it's too far gone. And that person just believes that their company's worth way too much money. So at that point, we really have to back off them as well, and most investors will also. So with that, that was the sorry about that. That's pretty much it. So I know there's probably some questions. I saw quite a few things in the chat box. So more than happy to spend some time here and answer any questions that are out there for everyone.
Well, we actually don't have any questions in the chat box.
No.
I've got one, and in the meantime, while I ask that, maybe some other people can put theirs in the chat box. They can also ask them live too, since we don't have it in the chat box. But let me start with, one thing I didn't see you address that I see typically involved in investment bankers involved in is ESOPs. You briefly touched on ESOPs, but is that something that your firm does, or is that really something that certain investment banking firms specialize in, and then they would, the individual companies are looking, and ESOPs would go to that specialized investment banker?
Scott, that's a great question, by the way. And I've probably set up 8 ESOPs on my own back when I was working in wealth management. At this firm, I have not set up an ESOP, but I just haven't been asked to yet. However, if I was asked, I would be the person that sets that up with normally an attorney to come in and really put that together for companies. And I do see a lot of companies establishing ESOPs at the beginning now. As a matter of fact, I'm in conversation with the software company that has an ESOP built for their employees, and they haven't even raised a Series A yet, and they already have an ESOP in place. So yeah, I love ESOPs. I think they're great. Again, when I talk to companies, I ask them the question very blatantly, what's your exit strategy? When do you want to exit? How do you want to exit? Let's start with the exit in mind, because let's set this company up properly so that when we get to that point of exit, we can actually exit. Because far too often you just get stuck in a corner, and you usually end up in a bad spot, either tax wise or you can't find the right buyer for what you're trying to sell. So I love ESOPs. So that is something that we would handle from our side.
Okay. Couple more questions.
Scott, in LinkedIn's Infinite Wisdom, they created a Q&A box. So there are some questions in the Q&A box.
So, okay. Well, I'm also seeing here in the chat from Omar, do you raise debt or equity funding directly from accredited investors? That's the first question.
So not normally. Most of my investors start at either multifamily or single family offices. So I would say they're more QPs than accredited investors. I normally don't go down that low, only because I don't want to muddy up the cap table. And most of the raises that I do from 15 to say on the equity side, 15 to let's say 150 million, I can usually get that even $150 million raise. I can usually get that with 4 or 5 in investors. It's not a ton of investors, and that goes for equity and or debt. It's normally a very limited cap table when we get done with a deal.
And then follow up to that is, do you advise on reverse takeover opportunity of already listed companies?
We can help you with that. Yeah. That's something that my managing partner, he actually has a background in, so he can definitely help you on a reverse takeover and or a delisting. He's also has knowledge in that. So that's definitely something we can talk through with a potential client.
And then the last follow-up on that from Omar is, what kind of legal implications for the C-suite if the financial forecasts provided are not achieved? What type of disqualifications are provided?
Um, I would say that, I mean, we're all, especially with especially with valuations and like projections, as long as the financials are accurate that go into the model, and the model makes sense, from an investor standpoint, that maybe they just bet on the wrong jockey, at that point. So I haven't been involved where somebody's committed fraud or overstepped on that front end and not given us accurate financials, so that we could build a forecast or a model properly. So I don't actually know the implications that would come down, unless there was significant fraud on that front end from a document standpoint.
Yeah, I know, having started my own business, that the insurance for people that are doing, let's say fractional CFOs or whatever it might be, that has gone up significantly to get that insurance, and some people won't even do it. Some of the insurance companies, so they almost, if you're gonna make forecasts that somebody's going to rely on, then we're not going to cover you. You have to find somebody else. So it definitely has changed over the last few years. Uh, I've got a question from Craig Campbell. Bradley mentioned he has EV auto platforms. Does he also have hydrogen powered auto platforms, or is there interest in that area?
Yeah, I'll take a look at anything. Especially, I'll be honest, like I'm not an ESG guy. Like I don't believe in it as an investment thesis. But I do love the companies that work in that space. So if anybody has any, especially environmental stuff or social stuff, I don't play too much in the governance side, but environmental specifically, like I love those projects. And I have a couple different EV. I have an agriculture play as well, two agriculture plays as well, that have to do with just utilizing and bettering the environment as a whole. And I do kind of have a passion for that. So yeah, I mean, hydrogen, absolutely. I think it's a great fuel source for automobiles or for any motor vehicle. Because I mean, what's the outcome? Water. So I think that's a great play for our environment.
Okay, question from Greg Townsend. The last slide on unrealistic valuations and expectations. Is there a format or program available that you recommend for determining what realistic equity give-ups are for entrepreneurs? I've heard this discussed a lot, but lack a quantitative way to understand, analyze this.
Yeah, there's really not a lot of software out there that do it. I mean, it's an Excel model for the most part. I use Excel. I use a lot of AI in what I do. I mean, my degree's in computer science, so in what I do, I use Excel and I use AI to, especially in the private side, find companies that have kind of similar financials. And I mean, it's really hard because a lot of times you have to go into that public space to actually pick off the financials of a company because they're not readily available on the private side. So understanding valuations and seeing valuations, I would tell you to Crunchbase is a great spot. PitchBook is a great place to go get valuations of companies. Now those softwares cost uh, quite a bit. I mean, PitchBook's 30K a year. Bloomberg's another one where you could, on a Bloomberg terminal, you could really pull down a lot of information that's not readily available. Free stuff, Yahoo Finance, some of the other Google Finance, are places where you can go and kind of download some of that data. But to answer the question on valuation software, I don't use one. I've probably gone through 5 or 6 books on financial modeling, and I just use the Excel that I built and the macros that I've built, and then use a lot of AI that I've built into it now, because it's AI is a wonderful thing if you know how to use it. It can short track a lot of things as far as building DCF models or valuations fairly quickly as well.
Okay, I got a question from Christian, the co-chair. How do you assess the true value of a business beyond traditional financial metrics like EBITDA and revenue? Which qualitative factors significantly influence valuation?
I would say the most significant factor is people, the executives, where they came from, what they've done in their past, how they answer questions. I've met a lot of really good CEOs who don't possess good skills with people outside of their organization who come in. That creates a problem in the valuation sometimes, because you have people that won't invest with that CEO because he or she isn't listening to the investors that might sit on the table themselves or on the board. That's one of the biggest areas in the qualitative space that I really see where the valuation gets affected. I mean, you have a startup or an early stage company that has an unproven founder, never done it before, never worked anywhere else. You see them get markdowns specifically from like private equity, private debt companies, and any of those organizations. So I would say that's the biggest area that I see where people are getting the excess.